Well, welcome to the Christmas and New Year special edition of The Trade-Off. And we look back in today's episode at the year that was in 2024, which has been a year of fairly low cross-asset volatility. But with the Fed meeting out of the way and with Trump due to be inaugurated on the 20th of January, I think it's safe to say that pricing risk in 2025 will come with increased challenges. And that could mean higher volatility. Now, in today's episode, we don't just look back at the year it was and review, but we look into our crystal ball and we ask ourselves, what are the trade in equities, in the US dollar and currency markets, more broadly, commodities, and also crypto going forward. So a big episode today. Join us for today's trade-off. Well, hello, my name's Chris Weston. I am Head of Research here at Pepperstone, and I am going to be joined by Blake Morrow, as always, from Forex Analytics, and we were discussing a special edition today. We're going to have a look at really what's worked and what hasn't worked in 2024, what lessons we can learn to project into 2025, and then more importantly, is because obviously market participants live in the here and now, and also some people live in the future. We'll have a look at what could work, some of the catalysts that could drive and change our market environment in 2025, and what structurally sort of our sort of directional biases and where they sit at the moment, where we see the skew of risk. So Blake Morrow, coming to the programme. I think it feels to me like there's still some money to be made or potentially lost going into the end of the year. Still feels like, it's a fairly defining Fed meeting. And I think if you're Donald Trump right now, you'd probably be pretty angry with what you heard. Clearly, some Fed members have considered his policies and put them into his forecast, which is a massive change from where we were in November. And they may not look to cut rates because of his policies. I think he'll be walking up in the halls in Washington in some kind of state. But it does feel like to me that was a defining meeting, and it will set the tone. I think that's through the looking glass and setting the tone for volatility in 2025.
Yeah, Jay Powell sure did bring his Grinch outfit, and it's interesting how we started the year basically at the lows in 2025, and here we are, a couple weeks left in the year, but boy, that was a significant turn. And I know for stock market investors, they're probably going to be pretty nervous the next couple of weeks, and at least the people at the Fed are probably fairly in decent shape. I mean, Trump's not wandering the halls over there. He's probably in Mar-a-Lago right now. So
playing a few games.
You got that.
I just think maybe this is the catalyst now for a few actives to say, do you know what? Done all right. I'm still in benchmark returns. Time for me now to cut this, call it a year, and hope that the market falls by more than what I'm performing. Maybe this is the time when some of these guys cut. Maybe we saw that last night. Anyway, let's go into some of the themes that have worked for this year, and then we'll have a look into our crystal ball. But I want to have a look back at some of the things that have worked. And specifically, Blake, I want to try and take out any learnings that we can have from this year to project into 25, because obviously we don't live in the past as traders and investors. We sort of work in what's put in front of us right there and then and in the future, but we learn from the past. And of course, that's what we're doing. So I think one of the factors this year is volatility. I know there's been some pockets of extreme volatility. Certainly, if we go back into early August, we saw cash VIX trade into 65%, and the VIX futures got up into the high 30s. But apart from that, the VIX index, if we use that as implied volatility in the equity markets, has averaged 15.4%, relative to the 5-year average of 21.3. FX volatility certainly picked up now, but for a large part of the year, it's been fairly low. I mean, EM FX has been absolutely smashed up. And that's very volatile. Things like, the Mexican peso and the Brazilian real have had some big moves, Aussie dollar as well. But for a large part, G10 or G4 FX has been pretty sanguine in terms of vol. Gold's been okay. Bond market volatility has been low. The lessons that we took out for me, talk to me why we've seen low volatility this year and how that may change to a degree in 2025.
Well, okay, so first of all, low volatility, and let's just talk like equities or generally speaking, low volatility. I think it's because the Fed and other central banks have been easing. I mean, that's it, right? Yeah. I mean, you've got the invisible hand of the Fed that keeps stocks elevated, and here we are, a couple weeks before the end of the year. And the Fed has now signaled, they cut rates, but there are traders now that are thinking, man, that might have been it. I know most traders are looking at 2 rate cuts in the next year, but we'll see about that, and we'll see about what happens in the months ahead and the quarters ahead. But I think that is one. The other one too is central banks have been moving in unison.
Yeah.
And when you talk about FX volatility, and you got the ECB cutting, the Fed cutting. The Bank of England has been thinking about cutting. I mean, you had a couple standouts like the RBA, but as you can see, the Australian dollar has taken a really nasty spill. Yeah, very. It just chopped up right. But for the most part, FX volatility has been fairly benign because all these central banks are moving together. It looks like that might change. And I mean, when you just from today alone, you look at how expectations of the Fed has changed versus you look at the ECB that are pretty much guaranteed to give you 2 more rate cuts no matter what, the next 2 ECB meetings, where the Fed, you're going, well, are we even going to get another cut? So yeah. I think that is going to spur that type of volatility, Chris.
Yeah, I think so. And I think we're going to talk about dispersions, because when you get divergence in policy settings, that's where you get trends in bond markets, and that's when you get higher volatility in FX market, which is great. Well, for people who cut their craft in higher ranges and trends and various factors, I love that. But I think also, there's just been an absence of any major shocks this year. I know we got that the dispersion trade unwind in early August, the yen funded carry trade, part of that, but that was like a 14-day drawdown in the S&P. I think lasted. We got about 9.7% drawdown that took about 30 days to come back and reclaim those highs. But we've seen, I think throughout the year up until today, we've seen three occurrences of the S&P was down more than 2% in a day. So just selling volatility made sense. Any spike in volatility, you just sold into it. And I think there's been this big wave of short volatility positions which need to be unwound in the new year. But the market has had a very complete absence of any major shocks. So when you've got the Fed put in play, the concerted effort from central banks to do whatever it takes to stave off any fragility in economics and the labour market, you just sell volatility and you buy equity risk, and pullbacks have been very well supported. So there's a whole number of truth. But I think next year things change, and I think that Fed put comes into question.
Might be a little bit of a different year. And speaking about this year, and I mean, I don't know how we could go taking a look back at 2024 without looking at what crypto has done this year. Obviously, the ass end of the move was after the election, but I mean, Bitcoin was already on the move. You look at Ethereum was moving, but now, I mean, we've seen these types of returns. You can see just on the chart that I put together. I mean, you look at the total crypto market, it has moved 125% from the beginning of January to right now, or at least to the peak that we saw, over the last couple of weeks. It's a 125% return cryptos. You've even had emergence of certain other meme coins like Fart Coin. That is a thing, Chris. I recently found out.
Funk coin.
Fart. Like fart. Yeah, no, look at it. It's a thing, and it's up. Well, it's probably down quite dramatically today, but anyway, the point I'm trying to make is everybody and anybody that I talk to is involved in crypto now, and it's been a really big theme. And of course, you guys cover a lot of different crypto. I could, Ripple, Cardano, whatever. I mean, there's so many different cryptos that you cover. How do you feel about what crypto's done this year, and has it really cemented its place in the financial markets after this year? I think so.
I mean, it's grown up in a massive way, and it's been a massive step forward for the crypto scene this year. I mean, the introduction of the ETF has been a huge step forward for the flows we've been seeing. It's been a major driver of returns across the different 10 or 11 ETFs. The introduction of the options market on the IBIT has been a big one as well, and I think that's get developed. I think in 2025 you're going to see a whole raft of new ETFs coming through on the likes of Sol and various factors. So again, it's taken a step forward with the reintroduction on a regulatory regime. They're getting into a much more favourable environment as well. Obviously, we saw the halving coming through, but I think the regulatory regime is going to change. Whether we get a strategic Bitcoin reserve is something obviously that we're looking to 2025 and assess the probabilities under the Trump administration. He certainly keeps to making us believe that it's possible. I mean, I don't think it's going to happen overnight, but it could do, and we need to be open-minded that if it was to happen, you could see some big moves higher in that. But you across the regulatory regime, across the development in the futures markets, in the flows that take place, it's been a giant step forward for crypto. It feels, you talk about the returns, but I mean, you have to look at it when you're looking at this. It's the volatility, adjusted returns that I think are really important. How much risk are you taking to get those 100% moves? And when we look at those, you're still getting very, very good, compelling relative returns to other asset classes, even though you're taking on that risk. So I feel like there's obviously, you say this, buy the dip. I love buying the dip. The question is where is that low? Everyone says buy the dip, and then they look like a hero afterwards because they say, oh yeah, I said bought the dip, but they didn't actually tell you where the low was. But I think there's going to be pullbacks. It's not going to be linear, and it feels the market is becoming more comfortable with Bitcoin being 100,000 now. It's lost that taboo of looking at that big number of 100 in front of it now. But yeah, I feel like it's taken a massive step forward, the crypto world. I feel like it's getting a place in a lot more people's portfolios, and I feel like developments for next year are really strong. So yeah, I'm for a TradFi guy, I feel crypto is pretty fly, and that's the way I see it. So I like it, and I think it's only going one way. But again, if you're swimming in those circles, you've got to be prepared for the risk. But this year in 2024, you've been compensated for that risk. So that continue to be the case? I think it probably will be. Anyway, let's go into the US dollar, my friend, because what was interesting is that we did this show back in this December 2023, which was this time last year, Blake, and the people who are paid to come up with FX forecasts were all bearish on the US dollar. There was a consensus view that the US dollar was going to go down across the board because the Fed were going to cut 100 basis points or so. There might even be recessionary fears, but they were going to cut 100 basis points or so, and the US dollar was going to go down against all currencies. I think the consensus on the Aussie was about 70 or 68 cents. Euro dollar was above 110. And how wrong they were, Blake. This is why you don't listen to outlooks. They serve no purpose for FX traders like you and I. They're good for treasury departments who want to lock in forward rates, but they just create biases, in my opinion. Even this idea about why they could get there, they don't offer any edge at all. So, but anyway, that we're going into another year where I think the consensus is that we're going to see a weaker US dollar. I disagree on that situation. I mean, the US dollar this year has worked against everything. Maybe the South African rand on the major currencies is still looking good. But yeah, in G10, it's up very strong, certainly against LATAM currencies. And we've got euro dollar down at 103 now. As you mentioned, Aussie dollar's been getting hammered. New Zealand dollar's getting smashed. The dollar is king in G10 this year. How wrong the forecasters were. Will they be wrong in 2025? What have you loved about the US dollar this year, Blake?
Well, I just love the fact that the market was, not only were they bearish once earlier in the year or at the very beginning of the year, but then they were extremely bearish in October when the euro was, trading at what, 110, 111. And then look where we're at now. We're at 103, just two and a half months later. So I love the fact that the dollar is trading. It's a trading vehicle on that, and it's going to continue to be one. And I think that the rise in currency volatility is just going to be great over 2025. So do I think the dollar is king? Here's the thing. I think there are risks this year as we head into 2025 with the Trump administration. I don't know if they particularly want a strong dollar. Well, I think so they've vocally said it. Yeah. Both Trump and JD Vance. So,
well, I don't know if they can whether they get their wish, but I think the interesting point on Blake, this is the dollar's worked on a relative growth basis and also to a point relative rates. It's not been working as a safe haven vehicle, which in times of stress, you're going to dollars, you go into the yen. Perhaps depending on where the situation lies, you might go into the Swiss franc. But we haven't seen on the terms of the dollar smile theory, we haven't seen dollar demand because of extreme volatility and a rush for safe havens. I think that may be a reason why we buy dollars in Q1, because we may see a bit more of a drawdown, a bit higher volatility. But yeah, the US dollar predominantly has worked because of its relative growth dynamics and the relative rate differentials. It's not because of the safe haven demand.
Yeah. All right. Well, the dollar is definitely going to be in people's, how do they say, there's a lot of people who say this, if you get the dollar right, you get the market right.
Often. Sometimes.
I think that's
I think bond markets,
sometimes.
bond yields are probably where you've got to look at the moment to get your bond call, and you're probably going to get everything right with the 10-year above 450 now, and could it get into 5%? For me, 5% on the 10-year is your line in the sand. So I think probably you're right, because if you get the dollar right, you can. There's a bit of, certainly on the EM FX side, but I think if you can get your 10-year call at the moment and the 30-year Treasury call right, then you probably get equity risk coming into that as well.
Oh, we're going to talk about that. So make sure you guys stick around for this entire show. All right, let's talk about the last review, the topic that I wanted to talk about. And I want to talk about just the S&P. And Chris, I want to state that I've been trading. I got my Series 7 license in 1996. So I started trading about a year and a half later in 97.
I was 98. And I was 98.
You were 98. So we've been around for a while. Now we've seen volatility and we've seen markets top to bottom up 30%, but having a market up and you can see this chart that I bring here is up 28% on the year. Now, obviously we've given back a couple of percentage points just today. But for a full year move, that's not normal. And that's something that I think the market and participants are really getting accustomed to these wild returns, whether it's in crypto, whether it's in meme stocks, meme coins, that they lose sight of the fact that, generally speaking, the stock market grinds higher over time. And, 3 to 5% annualized returns is like the normal. And here's the thing, Chris, I actually think that that's what's coming in the years ahead. I think we're stealing right now today away from younger generations returns in the S&P, if you will, those damn boomers. But anyway, I just want to point out that the S&P being up 28, 30% on the year is just not a normal market environment. What do you have to say about the S&P and the way the markets have moved this year?
I think you make a couple of good points. First of all, when you're in the investment game, understanding expected returns is such a critical part in your asset allocation, the CAPM model and all these factors. So you've got to, but I think people's expected returns have changed. They have changed. But I think also the dynamics within the S&P have changed. The fact that you've got Nvidia, you've got these high growth names which dominate the market cap now, and they don't move in 1 or 2%. These can have huge moves in a year. I mean, Nvidia's up 150% year to date, and it's got the biggest weight on the market. So this is why you're going to get, I think, that it becomes the new normal, that you get these really high beta, high market cap, high growth names now, which dominate the market cap of the S&P and the NASDAQ, that you probably could see markets being up 20, 30%, or they could be down 20, 30%, because unless some new leadership develops and banks or some of the more sort of stable earnings companies dominate, then as long as you've got these high growth names, then you probably will see big returns and volatility on a return basis. So I think that's the big thing that's really kept up. That the Mag 7 now, or the top 10 stocks, equate for about 33% of the market cap of the S&P. So these are not the sort of stocks that have 10% moves in a year. They have 20, 30, 40% moves in a year, which makes the S&P and the NASDAQ far more volatile. So I get what you're saying, but I think things have changed now with the dynamics of the companies that have such a big weighting, and that makes the volatility more volatile. So there we go. But I think growth's been a great place here as a trading theme and a thematic and a style and a factor. Growth has been the play. Momentum's done well. Banks have done well. Whether that continues in 2025 is obviously yet to be seen.
You see the grays right there? They're coming in, Chris. That's all Mag 7 grays.
I've got a few, mate. I've got a few. I can't have a beard anymore because it looks a bit grey these days. But mate, another bit year wiser. We'll see what happens next year. Anyway, let's go and have a look into the key themes. Blake, I'm looking at higher volatility, right? Because as I said, I talked about this, and I do think volatility for me, I've told it time and time again, I'm bored of saying it, but I'm not bored of saying it because I think it's so important. Volatility is the most important dynamic in markets for me. It dictates what strategy you're going to trade. Certain strategies do well in a high vol, low vol environment. It dictates our emotional state for discretionary traders, not algo traders, but discretionary traders can be affected by high volatility. Our hold times, the duration of hold times, the frequency of trading, the direction of trading, position sizing coming through in the market. It really is the epicenter of the world. Now, I think if you look at the sort of high-low trading ranges this year in a lot of equities, they've been lower. They've been certainly down from the year below. I think we're going to see higher volatility in equity markets. We're already seeing it in FX markets. I think commodities will be a bit more volatile and rates markets will be more volatile. Why do I think that? Well, I think you've got that policy uncertainty. Will the Fed cut rates again this year, next year? I'm not sure they will. What the Fed have done there is they've raised their PCE inflation core numbers by 30 basis points. Some of them even on an assumption of what Trump could do. You got Trump on the helm there as well, and I think that's going to be something that's really, really impactful. So will we get a recession in the US? It seems pretty low at the moment, but never say never. I just think markets are very short risk. Very short volatility. They're very saturated in positions. Valuations are very high. There's no equity risk premium, and I feel like volatility is assured here.
Well, did you say assured or a short?
No, assured. I feel like nothing's assured, but when I look at get a piece of paper, get two pieces of paper, and one of them write a list of all things that could cause high volatility and ones that could keep volatility suppressed. I can make certainly more on the left-hand piece of paper.
I would agree with that. All right, Chris. Well, I say one of the themes that I'm going to be looking at this year is obviously higher rates, especially after today. I mean, today was exactly what the market didn't want to see. And you saw the 10-year start to perk up. And what's the level you're looking at? Above 450?
5%.
470.
No,
5%.
I think that was the big highest. I mean, look, pick a number. I mean, ultimately the market will tell you where it wants to go. But it depends why it goes there, Blake. If yields are going up there because of right tail risk inflation, that's bad. If it's going up because of growth dynamics, then I think the market can absorb that better. But if it's right tail risk that's pushing up yields, then I think that's bad. And supply.
Yeah, and that might be the risk as we go into. Obviously, the market's a little concerned with what we're seeing as far as data goes and why rates are pushing higher. I have this chart and I wanted to just show it to you really quick because you can see the rise in the 10-year yield. And when it went up back in at the end of 2022, early 2023, the stock market's in red, and you can see how we hit lows then. And when we went up again at the end of the year in 2023, like in September and October of 2023, the market came under pressure as well. And here we are again. Rates are starting to move higher, and they're starting to break above that 450 level, and that usually spells for a little bit of trouble with the equity market. So my question is, and I think that the theme I'm going to be looking at is, how do the markets wrangle these higher rates? And what do you think? How do you think about that, Chris?
Well, as I said, I mean, I think it depends on why it gets to that point. I think what's happened with the Fed meeting now is they have last year for most of this year they were so hell bent on looking just at the labour market and trying to set policy around fragility in the labour market. That's still very much the case. They're still looking at the labour market very good, but I think they brought back in the idea that we could see higher inflation, and that was a pretty punchy revision, 30 basis point revision higher to their core PCE number at 2.5% for next year. So they brought in some right tail risk back into the market, and I think that this probably feeds into my slightly higher volatility regime playing through. But so it really depends on why. Is it because of increased supply for treasury issuance going forward? Is it because of inflationary concerns that are rising, inflation expectations rise? Is it because of better jobs numbers, better growth data? As I say, I think if it's somewhat to do with the inflation story, then 5% is just a magical number. But I think that could be a line in the sand where some of these duration assets start to say the present value's falling because the discount rate's moving up pretty sharply. But again, it's also the rate of change you've got to look at. It's not just do we see a grind higher in treasuries? What we've been seeing last couple of weeks is a pretty radical spike higher, and I think that's quite hard to digest. That's hard to price the risk around that.
Very good.
Let's talk about China. China's been a frustrating one for a lot of people who've been looking to be aggressive and buying Chinese equities this year, Blake. We've been given sort of talk of fiscal stimulus and various measures to drive animal spirits and try and create reflation. If you have a look at their 10-year treasury or 10-year government bond, I think it tells you everything that the market's saying. That obviously we're getting easing of policy, but it's not going to create inflation at all. And we're waiting for that definition of a plan. That plan is expected to now come in the NPC meeting in March. There's a good chance that we could see Chinese markets rally on high expectations into that we get the definition, the substance of that plan to really push the animal spirits out. And that would come after some of the tariffs have been placed on their economy. And the Chinese, as we know, like to wait to the actual meat on the bone and know a bit more facts before they set that policy. So I think there could be a tradable rally going into that March. Market is very much underweight China. It's underloved. And I think that there could be a situation, even though we've got the Trump tariffs hanging over their heads, we're also going to see a weaker yuan, I think, in that situation. So I think China's another market this year that could be up 40, 50%, or it could be down 20%. Well, I don't think we're going to get a mediocre, very small, sanguine returns. I think it's going to be very, very big for the volatility. So I like it. I don't think that Trump tariffs are going to come out anywhere near where he's been speculated, which would be good for China. So I think it's a must-watch market. What do you think?
Well, I have a hard time expressing my China ideas, trading, being a U.S. trader, but I predominantly through the Aussie dollar and not even the CNH because of my brokerage firm that I have to use being in the U.S. But the Aussie's obviously been in the toilet. I really want it to be a tradable idea, and I want it to be an idea that I could play on the long side. But the way the Aussie dollar is acting right now, it doesn't seem it's going to be in. At least not until Trump takes office.
Overlay a chart of Aussie dollar and Aussie against US dollar and dollar CNH, and it's moving tick for tick inversely. Yeah. So the question, I think this is if you're a currency trader and you're trying to express dollar CNH, why would you go for dollar CNH when you can go for Aussie dollar and pay a fraction of the spread? So I think it's a cost-effective vehicle of trading the same thing.
There you go. All right. Well, speaking of Trump, so one of the macro themes that I wanted to talk about for the next year is obviously Trump. He's front and center, whether you like him or whether you don't. If he's your president, he's not your president. Doesn't really matter. He is a wrecking ball or a bull in a china shop, however you want to look at it. But between tariffs and, as I said earlier today, maybe not so eloquently on one of my shows in our community, he could be sitting on the golden throne at 11 o'clock at night with his phone and tweet something that could really, really move anything that you're trading at any time. You have to take him into account. I don't think he's going to be quiet, and I don't think he's going to change from this second presidency to his first presidency, first term, meaning that I still think he's going to say things and off the hip, and it could greatly affect what you're doing. And I think that's going to put the dollar squarely in the microscope, because there at any moment he could really tweet something about not comfortable with how strong the dollar is, and that could upend anything that you've seen in the markets at any time. So Trump is he's a force to be reckoned with. And I think we're going to have to. Did you get your Truth Social account yet, Chris? I've got mine.
I've got mine. Yeah, but that's it. You make a good point. It's not just about the way that we're going to dissect news, and we've got to understand what's signal and what's noise and how the market digests it. But I think the other thing is that we do need to understand that Donald Trump needs to come back to the American voters and make him look like he's hardball, that he's fighting for their rights and he's fighting for the best outcome. What actually happens behind closed doors could be a very different situation. I mean, the Chinese are going to do the same thing. What's going to be portrayed in the Chinese media and in the Canadian media and Mexican media is that their negotiating teams are going in hard and fighting for their rights. And so everyone's going to be saying we're winning in the art of negotiations. We're winning. We're doing the best. Trump might probably be the loudest, of course, but actually, what happens behind closed doors is it's going to come in and say China wants 60% tariffs. We're going to take them up 35 percentage points over a staggered basis, unless you do something. And that thing could be anything. It could be around fentanyl. It could be around other factors. But where we settle in the end, I think will probably be somewhere different. But we are going to have to try and in 2025, we are going to have to sift through what is noise, what is signal. Obviously, price will tell us what the market thinks, and that's what we're trying to understand what the market believes is signal. But I think we are coming into a different regime where it's going to be so much more noisy, and their pricing risk will be more of a challenge in 2025 with that unpredictable nature.
Absolutely.
Yeah. So you get your news recognizing algos to jump in as soon as you can, mate, because we won't beat them. That's what you need to be saying to. Anyway, good work. Let's go into some of the plays of the year that will be. Right. I'll take the reins. Sorry, Mr. Blake. I'm going to continue with the US dollar as my pick. Now, I'm not going to say this is going to work all year. I have no idea. I don't like to make calls for 2025 for a full year. It's nonsense. And of course, that's no one ever actually makes any money from doing that. But I think right now, if we're looking into Q1 and sort of where the probabilities lie, we are going into the year hot. I mean, the dollar index is trading at the highest levels since November of 2022 or 23, I can't remember. But it's certainly breaking out. Euro dollar's obviously driving that. We've got that momentum coming through. I do think that that from a rates perspective, the introduction of inflation risk, we'll probably see the Fed on hold for a large period of time. I think they probably won't look. The market will start pricing in the first rate cut now, not until July of next year. That's a dollar positive. If we were to see some higher volatility, then we could see the US dollar benefit from that situation. We've still got a relatively better economy. Powell talked about that. One concern for me next year is if the dollar does get too hot. If equity markets draw down, you may see a situation if US economics does start to reprice in rate cuts because of the tightening of financial conditions. That could see a situation where the dollar falls, but on a select basis against the Japanese yen, maybe against the Swiss franc. So for now, I take a broad US dollar positive view. If we were to see markets getting hit and start repricing rate cuts because of deteriorating economics, then I think you want to be selecting, and I think probably dollar yen would make sense in that situation. Short. I'll go to the macro thematic, which I think is one of the bigger ones, and we talked about it throughout the show, and that is this uncertainty, not just on at a political level and what Donald Trump's going to bring and what he's going to say between the various negotiating teams, but also in terms of central bank policy. And it's something Blake brought up earlier. For me, currency trading, one of the most simple forms of understanding from a macro perspective is the divergent settings. And I think we're seeing increased diverging settings playing through. The RBNZ, they may be getting closer to a trough, but they've still got more cuts to come. They're in recession. Their economy looks disgusting on a relative basis. And I feel if we do see a slowdown on a global basis, concerns about tariff risk really manifesting, China, seeing high volatility, then I think New Zealand, they're setting policy. I think the RBA cutting rates maybe even as early as February. That's a new dynamic. The Bank of Japan, the higher dollar yen goes, of course, the more likely they are to be hawkish. That's a separation. The Fed, have brought in right tail risks and inflation into their mix again. They're starting to go one way. The ECB are going one way. The Bank of England, you're starting to get much more divergent themes. So from a fiscal policy perspective, you're getting dispersions amongst governments. Deficits are changing, but from a central bank perspective, I think you're seeing much more divergence. I think that's going to be a clear theme, and I think that's going to create higher volatility on a sustained basis going forward.
All right, Chris. Well, my key topic chart that I really wanted to talk about is something that we talked about at the end of last year. I believe at the end of last year, we talked about, is 2024 going to be the year of the yen? And you know what? 2024 has brought a mixed yen, but this year could be the year. This could be, and actually we could be kicking it off as early as in a couple hours from now, from the time that we're recording. We're going to have the BOJ, and there's so many news outlets that have given the market the idea, set the expectations there's not going to be a rate hike. But after the BOJ just saw what happened with the FOMC today, and considering the fact that Ueda's hasn't said anything really about rates other than he thinks he should be gradually raising rates, we actually might get a rate hike, and this is going to be that divergent central bank potential policy might even start to evolve at the very beginning or very end of this year, beginning into next year. So if you look at the yen, longer term, we actually have this inverted head and shoulder pattern that is developing that I think is technically, if we're creating a higher low, the yen could really start to strengthen. There is a cost to carry when you're trading the yen, so you have to take that into account. Now, the macro theme behind that is, again, how is the market going to deal with higher rates? And I know I talked about this a little bit earlier, but it's not one size fits all when you're talking about central banks. We have the Fed, where expectations have shifted dramatically, obviously today. But you look at last week, in the ECB meeting last week, everything had shifted towards the ECB cutting and consistently cutting over the first two meetings. And that is two divergent central banks today. And you see what's happening with the euro US dollar exchange rate. You're going to see more of that as we go through the 2025. I think you're going to be seeing, as Chris mentioned, different countries have to respond differently based on what's happening with tariffs in certain countries. Mexico is one of those standouts that I think there might not be tariffs, and you might actually have Mexico that has to deal with inflation. They might actually have to raise rates where other countries are not, and they might not have such a huge tariff impact if they're working hand in hand with the U.S. government. But singularity stories like that between the U.S. and different countries, I think, is going to be the overall macro backdrop of what we deal with in the markets for 2025.
Yeah, good point. I think certainly the tariff risk is something that we're going to debate in Q1 quite a lot. Blake, I just want to quickly touch base because there's been a couple of viewer questions last week, giving us the lead up into today's episode. We got Tembo. Tembo asked about copper, and I think copper's a really interesting point now. Have you got any views technically or fundamentally about how copper should shape up into 2025?
Well, today was a scary move. So we are actually on triangle support right here, just above 410 or just around 410. But we get much below 4, it opens up 390, which is a longer term trend line. So I would just say if you're looking to be long, these are the levels we should bounce. But if we don't, there's another, I would say there's another 10% at least below.
I quite like the fundamentals on copper for 2025, but I think it right now the semantics are brewing to the downside. I feel like there's probably some downside in the short term. But again, it comes down to my point on what I said with China. If we go into this NPC meeting and actually believing that we are going to get that definition, we've got the Trump tariffs known a lot more to the Chinese. They can therefore set policy in a much more clearer light. And if the market genuinely believes this time will be the time that the Chinese come out with that defined plan to drive animal spirits, to go hard on the fiscal and change the psyche of the household away from savings and paying back debt to actually spending money with that new change that we've got in their stance on monetary policy, I think copper will be standing to benefit because a lot of what they're doing is on the housing front. So I think a bit more downside, but I think copper, when we go into that, could have a big reversal. The other one that we want to touch on is Stuart's comments about US housing, obviously something that you probably see anecdotally around you. But for me, Blake, if I have a look at the home builders at the moment in the US, we can tell the housing stats in the US are pretty woeful. I mean, Jay Powell touched on it in the Fed press conference and said that housing was weak in the US, and you can talk about some of the factors there. But that the XHB, which the home builder ETF, is in absolute free fall at the moment. Rallies are to be sold, if not go straight outright short now. And I still feel like it's an area that needs to go lower because it's the most interest rate sensitive part of the economy. The consumer's not shying away at the moment. But if you're going to raise rates or you're going to have high elevated rates for a period of time, and we've seen that in mortgage rates, the home builders and the housing stocks are going to be the ones that get affected primarily. And home builders, for me, continue to be a short. What do you think?
Well, as far as the housing market goes, what happened today with the Fed is only going to make mortgage rates higher, and it's just going to slow down. It's just going to slow down the U.S. Housing market from a sales point of view, and it's really not a problem, Chris, until the jobs market becomes a problem. Once the jobs market becomes a problem, if you lose your job, you can't pay your mortgage, you have to sell your home, and you're forced to liquidate. Then you start cutting, and that's when people start cutting prices. We haven't gotten to that point yet. Our jobs market still looks pretty good. So hopefully we don't get into that. But if you start to see the labor market soften and you start to see job losses consistently, the housing market's going to be, especially if rates haven't come down and the Fed continues to be stubbornly hawkish, if you will, because they're fighting inflation, the housing market's going to suffer as a result. And we are not seeing it yet. We're seeing a crash in transactions right now.
You want to have a look at look at layoffs in 2025 because layoffs are pretty low at the moment. Then people aren't losing their job. If you've got a job, you're fine and you're doing all right in the US at the moment. But obviously talking about quits and stuff. But I think layoffs could be a big one. But I think for me, it's difficult to be long housing stocks, especially with the Fed looking like they want to change going forward. So an interesting one. But anyway, thanks for the questions, team out there. Any further questions, do reach out to Blake or me. We would obviously be happy to answer them. Anyway, Blake, that's it for this year. Obviously, a lot going on into the end of the year. We've got to sort of feed back to people about where, how you manage the risks around a less liquid period in the market. And that's obviously going to cause more exasperated moves playing through. But I want to thank you, Blake, for all your hard work and thoughts throughout the year, some of your great calls. For everyone at home who have been staying with us and watching the show and giving us your feedback, we really, really appreciate it. We hope that you have a good Christmas and a happy and prosperous and safe new year going forward. If you want to leave any reviews on the situation, do so, and we'll be back more for next year, and have a great holiday.